Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates market. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Nevruzi. Okay, a big week of central banks, so let's start there, albeit perhaps not the most exciting week of central banks that we've ever had, certainly not in this cycle, but worth discussing nonetheless. So Jan, let's start with you. The Fed, well, I guess for both the Fed and the ECB, as we discussed on this pod last week, I mean, it felt like 25 basis points was really very much nailed on for both of them. But what were the other key takeaways, I suppose, from the FOMC meeting this week?
Yeah, like you said, it wasn't that eventful. For the most part, the Fed exactly delivered what markets were expecting. They didn't really waver into either direction, particularly in a forceful way. Just to summarize what we got, as expected, 25 basis point rate hike, with kind of leaving optionality open for more if needed, if not. That was well priced by market, so it didn't really lead to a unexpected move by the central bank. When asked about the statement itself, when released, it was essentially unchanged, very, very close to unchanged from the one that got in June, of course, with the exception that this time it says they're going to, they decided to hike rates as opposed to the pause in June. And finally, the press conference was, I'd say, a pretty good performance by Powell, who was just kind of, it felt like, I think the crux of the press conference could be summarized in one of the questions, where he answered like in the way that we have two more inflation reports until the next meeting in September. If it looks like inflation is not accelerating in a way we want to see, we can hike again. If it's moving the right direction, we can skip September too. Effectively saying we're not locking into anything, and we will wait and see for the data. I think that's, of course, the right approach. Inflation is the last inflation number, which I guess we've talked about plenty in this podcast, was pretty encouraging. If we get another one of those, we would expect for the Fed to keep rates unchanged at the September meeting. Well, we expect the Fed to keep rates unchanged at the September meeting. In fact, we don't think we'll get any more rate hikes. That being said, in the interim, of course, we could see fluctuations in rates up and down on the back of other data, such as today, just before I came into this room, we had GDP, we had the weekly unemployment claims, both showing some strength on the headline. So you saw kind of like an easing the previous easing that we got from these European Central Bank, which I'm sure we'll talk about in a little bit. So of course, I think now we're kind of getting to a point where we have to balance an interesting dynamic between how soon can the Fed turn around versus how far they can go, and how soon I think will depend on inflation, while how far depends on kind of on the labor market. If we somehow manage to pin a miraculous soft landing or no landing at all, then they might have to reduce rates, but maybe keep them higher for they just reevaluate your real rate estimates pretty seriously. But September we think is a hold. 25 basis point hike, not much changes in the statement, and a pretty neutral, well-delivered, I thought, press conference.
Just to clarify on, the House view as a base case, then when you say September as a hold, you're not implying that you think they hike beyond September. You think that this is the peak in the cycle.
Yeah, that's right. This is the peak in the cycle. Sorry, I should have mentioned that. They hold in September, and from there on, we actually still have an interest rate cut in December. So we'll see how that plays out. You don't necessarily have to get a collapse in activity for the Fed to turn around. If you have core PC something in the 3% range at the end of the year with clear trend to the downside, well, you just have to adjust policy to get to a more, to not get more and more restrictive each day and just maintain neutrality. You would have to cut nominal rates. So we'll see. I mean, I'm sure this will be a heated topic at the November Bondcast.
I'm sure this is the forum where we will have many discussions about that to come. I will come back to you, Jan, because I want to talk to you about the refunding announcement next week. But while we're on central banks, perhaps we can just stick with central banks and flip over to Europe, where we are recording this straight after the ECB meeting on Thursday. Again, a 25 basis point hike was pretty much nailed on. Did the rest of the meeting and the press conference meet your expectations, or what else were the key takeaways for you there, Giles?
Look, I mean, I think it sort of did, although it was actually it was on the dovish side. I mean, that's the really important thing to say. I think my expectation and that of many was that this was possibly the first meeting that of the ECBs in a very long time where they haven't been keen to deliver some kind of clear slant in terms of forward guidance. And that was basically what we got. I mean, I think that the key takeaway is they're probably done now. All right. And whilst she was cautious about the way she described the data dependency and so on, and that things can change, and of course, it may turn out that they need to raise rates at some future meeting. And so there was a little bit of a residual hiking bias, as you would probably expect. They weren't talking about cutting rates. I think the clear impression here was that if everything goes according to where the weight of probability is in terms of the data over the next 6 weeks and beyond that, to be frank, they probably don't have to raise rates any further. And so naturally the market's kind of like that. How did she deliver that? Very, I mean, she found her poise finally, and it was actually quite a convincing, maybe with an easier message to deliver, to be honest with you, but it was quite well and quite clearly delivered. I didn't find anything all that surprising or difficult to understand about it, to be perfectly honest.
Oh, nice. And just while we wrap up on the ECB, on this reserve remuneration story, is there anything worth discussing on that front? I know the market kind of perhaps slightly misinterpreted what it was talking about initially.
No, that's right. I mean, there was a knee-jerk where the market they saw the phrase reserve remuneration and assumed that it was talking about, at least this I haven't spoken to anyone about it, I would just infer from the market reaction, the sort of knee-jerk assumption was that it was talking about the remuneration of government reserves. And it took a few minutes for the penny to drop that it wasn't about that. It was actually about a kind of reverse tiering arrangement of the kind that we did to death, to be honest with you, around sort of September, October last year, when there was a lot of interest in this. And what all of this means really is that the ECB is basically starting to implement a reverse tiering arrangement. And so what's happening here is the exact opposite in sense of what we had when we had negative rates, and we had a tiering arrangement to try to save a little bit of the famous tax on banks. So there was there was tiering that was put in place to kind of protect banks a little bit from that. And now what's happening is that banks are going to be essentially charged, in inverted commas, for their required reserves. They can't escape this. Okay, so there is no question that banks will, for example, go and try to invest this money in other stuff because they must keep this level of reserves at the euro system. Okay, so you can't say, "Oh, I'm getting zero at the euro system. I'll go and buy some cash instrument instead." Then, the technical side of this is that basically the way monetary policy is meant to work, and the way it does work, is that short-term interest rates are basically guided by I guess, the marginal return on cash in the banking sector in the market for ECB reserves. And that's really determined by excess reserves. And the ECB will continue to pay the deposit facility rate on those excess reserves. And there are about 3.5 trillion of excess reserves still in the system. So this lower rate that they're going to be paying on 170 billion, okay, is a very, very, very small component of that, and it shouldn't affect market rates at all. And this was discussed, as I said, we did it to death before the end of last year. So maybe we'll come back to it, and I'm sure there'll be questions on it, but it shouldn't have a market impact. My concern, or at least my curiosity, is whether this is just a first step and they might now add a multiplier to this. There's nothing really to stop them doing that. It's just a calibration that they will want to consider based on how much money do we want to recover from the banks here. So I definitely think that this could continue to increase, and that may be, above all, that's probably just a negative for bank equity. If it's anything at all. That's it. All right. Sorry, got more technical than I think I was hoping for myself. Imogen, I'm going to come back to you because you've also been thinking about the central bank that you cover, the Bank of England, and that's in contrast to the Fed and the Bank of England, and the ECB, where everybody was expecting the 25 basis points, which, surprise, surprise, was delivered. It's a little less clear in your case. So I wonder if you could just talk us through where you sit on the 25 versus 50 debate for next week.
Yes. On the 50 side of things, but I would say narrowly in the 50 camp. If I had to put a number on that, I would put 60% likelihood of 50 basis points and 40% of 25. So, this is clearly not a high conviction view. But I still think, as I think I, went through on the podcast last week, that a 50 basis point hike would still be consistent with their reaction function at the last meeting. Now, if we remember the last meeting, that was when we had this kind of hawkish reaction function shift from the BoE. They hiked 50 basis points. The vote was very unanimous, 7-2, which really, if you think about that in terms of today's MPC, is probably more like 8-1, because one of the two votes for unchanged has now left the committee and been replaced by Megan Green, who we presume would have voted with the majority, or presume will vote with the majority. And, they kind of introduced some hawkish language in the minutes, which we went through at the time. But the point is really, I think, the market has got very excited about the possibility of a step back down to 25 basis points following the downside surprise in US inflation, and B, the then subsequent downside surprise in UK inflation. And we went through the reasons why I didn't think that was a huge deal last week, but it's probably worth remembering, particularly in light of the kind of discussion that we've had today with the Fed and the ECB, that the UK is still in a very different position when it comes to their inflation outlook. We're talking about inflation headline and core, well, essentially being 8 and 7%, whereas in the US we're talking about them being 4 and 3%. That's a different backdrop, for the central banks to be considering. We're also now at a much higher point than we thought we would be just a couple of months ago. We've had 80 basis points of upside surprise on core inflation over the last couple of months, offset by 20 basis points of downside surprise. It's difficult to think that really moves the needle in terms of the Bank of England's reaction function. But more importantly, and this is what Ramsden reminded us of in his speech earlier this week, last week, was that, the reason really why they hiked and they have, been driven into a more forceful react function is around wage inflation and services inflation. And both of those are still very high, higher than they thought they would be, higher than they would like to be. And certainly in the case of wage inflation, trending in the wrong direction. So it feels like a close call, particularly given that the activity data is softening and some of the forward-looking indicators on the labour market side have turned. But they've kind of been placing less weight on that activity market data. And even in the last minutes, they said that the forward-looking power of things like the ratio of vacancies to unemployed, for example, has not been tested in this high inflation environment. So if they remain consistent with their reaction function at the last meeting, it feels like the data still, is strong enough that they would need to do 50 basis points. But, with this BoE, it's a big if about whether they remain consistent with, what they were telling us just 6 weeks ago. But yeah, overall, I'm, narrowly in the 50 basis point camp. And I think that is probably, with a vote of 6 in favor of 50, perhaps 2 votes for 25 basis points, and Dingra continues to vote for unchanged rates.
Great. So a follow-on question from that then is, I'm just wondering if there's anything other than via the size of the hike and the vote itself, that they might use to try to steer market expectations looking ahead.
Yeah, well, they obviously have the forward guidance as well. I mean, it's kind of I feel more conviction around the fact that they won't change the forward guidance and on the size of the hike. So they still have this language around, if they see more persistent inflation, then they will, hike further. So it's kind of asymmetric, skewed towards further hikes. And I expect them to retain that optionality. Obviously, in a more dovish scenario, they could be a bit more balanced or a bit more symmetric about the way they see the direction of travel. But I still think that's quite unlikely at this point. It's a quarterly MPR monetary policy report meeting, so we do get an update to all of their projections. I think it's quite likely that we get small downward revisions to both their inflation and their GDP forecast. Inflation driven largely by the fact that there's a considerable amount more tightening now being priced in than there was just 6 weeks ago. If you take the 15-day average is something like 125 basis points of additional tightening over a 1-year horizon, than there were, not 6 weeks ago, but I mean when they last ran the forecasts in May. And so that clearly has, an impact on inflation over the kind of 2 to 3 year horizon. But generally speaking, the forecasts have for a long time now been showing inflation well below their 2% target over that 2 to 3 year horizon. Even back at the end of last year when they hiked 75 basis points, they still had inflation below their horizon. So the forecasts, as kind of a part of their forward guidance, have lost a little bit of their relevance, I would say, and therefore, have lost a little bit of their relevance to the market reaction too. So probably more going to be about, any changes to the forward guidance itself, but the vote, the size of the hike clearly, because that remains very uncertain at this point, but then just, the tone of the press conference, I suppose markets will take more of a cue from than the forecasts themselves.
Okay, and then the obligatory question, I suppose, just to round all of this off, what does it mean for markets?
Well, markets certainly are priced for 50 bits now. So I think that would be the more surprising outcome, particularly following a dovish ECB. I mean, when I left the desk, I think it was something like 35% chance of a 50 basis point hike being priced in. So, you get a bit of a knee-jerk reaction at the front end. I think that you would probably, my sense is that, this won't be delivered as a one and done. They won't be delivering 50 basis points because they think only 50 basis points more tightening needs to be delivered. And therefore, let's just do it now and get it over with. I think that it will be delivered as a 50 basis points and probably a little bit more to come, just because, there are more persistent inflationary pressures than they saw just kind of 6, 8, 12 weeks ago. And so I think that you probably get an immediate repricing of terminal rate closer to 6% versus the kind of 5.8 that we're at now. And that probably, you get a knee-jerk sort of flattening of 2s10s off the back of that. I think the market maybe prices in a higher terminal, but then on the flip side, perhaps a bit of an earlier pivot, and maybe, concerns around recessionary risks also weigh on the curve slightly as well. I mean, I do think overall, we've been talking about steepeners a lot on this podcast and writing about them a lot. I still think that is the kind of medium-term direction of travel, and perhaps any, major flattening after the Bank of England might provide attractive entry opportunities for steepeners, because I still think the weight of supply and, that driving our kind of bearish, longer-dated view will still matter. But I think it will be difficult it's difficult to see anything else happening off the back of a 50 basis point hike from the bank, I think. Okay, enough on the bank. Back to you then, Jan. I said I was going to ask about the refunding announcement next week. What are you looking out for in terms of, I guess, the breakdown of supply and the overall numbers?
Yeah, so after an extended period of unchanged issuance sizes in non-bills, like let's call them coupon securities, now we're going to see an increase again. Well, most likely we would see an increase again starting from the August period. That's largely due to deficits kind of running a little bit larger than what was anticipated earlier. Some temporary factors, but also some non-temporary. The temporary being, for example, California and some other states, but largely California got an exemption from the tax deadline earlier in the year. So those payments will come later on throughout the fiscal year. That's going to take some time. Spending has been running a little bit hotter. Generally, like I said, tax receipts have been a little softer. So funding needs are growing, especially if we see the economy slows down like we expect into next year. You would see these automatic stabilizers adding more to the deficit. So we think funding needs, and I'm sure Treasury has a plan in mind where funding needs will keep growing through next year as well. We got a large supply of bills. Just to give context, about 600 billion was issued from June to August, and we expect to see another 600 from August through the end of the year. So substantial chunk of new issuance coming to the market. And what we're looking for in note and bond increases, anything except for the 20-year should see option size boosts in our minds. The 20-year underperformed since its introduction during COVID, and it really needed to be downsized to get to a little more attractive and relative value metrics, not consistently end up overpaying for some duration premium from the Treasury side. It's still a pretty cheap issue, but nothing like like a year ago about this time. So no increase in the 20-year. We have only 1 billion in the 70-year note, because that also tends to be a little weaker sector on the curve. It was a workhorse during COVID, and I think it left some lasting impacts, as liquidity there is not as good as the 5 or the 10-year. And everything else, the 2-year, 3-year, 5-year, 10-year, 30-year, they should, in our view, get some 2 billion boost a month. So we're starting to move in that direction. Supply increases are coming. Again, we expect more bill auction increases, like I pointed out earlier, but that might come later in August, again in October in our model forecasts. And again, once we get to November, we think we will see another round of increases in coupons. So this trend of either decelerating or like decreasing auction sizes or flat auction sizes might be over for the time being. And with growing deficits, investors should get ready for gradually increasing higher net supply in bonds and bills.
And then just to wrap it all up, Giles, we've obviously talked for the last couple of weeks on this pod about Spanish elections. I know it feels like they were a long time ago now, but it would be a bit remiss of us not to mention the results and, what we think that means about Spain. We've been saying for a long time that we felt like there was a long list of positive fundamentals that meant that Spanish bonds should kind of converge towards semi-core. Obviously, the election result wasn't the most favorable from a market perspective. Does that change the way that I guess first of all, what do you see as kind of the path here for the politics, but then B, also, does that change the way that you feel about Spanish bonds going forward?
Well, I'm actually going to turn that around and answer the second question first. It doesn't really change how I feel about Spanish bonds. I think that there was the potential for a little bit of upside on being a little bit accelerated by the political process through the ratings channel, and that's probably pushed back again. But the story is still a good one, and actually, today we had unemployment data for the second quarter, and it was absolutely fantastic. Employment is absolutely powering ahead in Spain. They're back, well, I mean, at record highs for employment, long-term lows in unemployment, and so on. I mean, and as you get into the details, the details are all quite positive as well. So, I think the basic answer to that question is you're still focused more than anything on the fundamentals and the cyclical story, and that's all clearly still quite supportive. On the politics, it's blocked, right? We can see that neither the left nor the right has really has an easy path. If anything, actually, the left has, frankly, has the only viable path to forming a government, and it may or may not wish to pay the political price to tread that path. The timeline now, if people care, I think we've had a few questions, so I think people do care on, but is that the Parliament will be sort of constituted on the 17th of August, and then there is a reasonably sort of swift timeline towards the first investiture votes, which may or may not take place. I mean, that doesn't have to happen, by the way. But I would expect that there would be votes probably at the end of August, and when the first one happens, and that kind of sets in train a 2-month kind of window where you actually have to have a government or you have to go and have new elections. At this point, it seems like the Pedro Sanchez's party, has decent momentum in the polls, and if it maintains that, then it might well be in his interest just to back away and go to new elections. But that isn't my base case. My base case is that we will see him form a government in minority, basically along the lines of what we've had over the last 4 years. So that's that. Let's see. I guess we may come back to it.
I'm sure we will. Okay, that's a good place to end on this week. Thank you both for joining me, and thank you to our listeners for listening in. Just a reminder that if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.